Well, for more on the jobs numbers and the U.S. labor market, I'm joined by Robert Brusca, live from New York. He's the chief economist for Fact and Opinion Economics. Welcome to the show.
Thank you.
Now, as we saw, the U.S. unemployment rate went down to 4.2%, but we also saw the first monthly decline in jobs in 7 years. So how much did the recent hurricanes play into that, as opposed to, say, other factors?
Well, this is probably almost totally a hurricane effect because job growth has been fairly robust, and there's no other reason for the jobs to have declined like this. So this is a hurricane effect, and it's hard to tell what other statistics in this report the hurricanes might have affected. Even the average hourly earnings, the unemployment rate itself, the labor force participation rates. When you start distorting the report, you just don't know where it ends until you get through this difficult period.
So then which industries would you say saw the biggest shift in September?
Well, eating and drinking places lost a lot of jobs, and that's not surprising. In fact, I suspect that we're going to find the job losses were much bigger. In a previous report from the ADP, for example, it had showed us that the biggest job losses were in small firms, and these are usually the last firms to report. And so I think by the time the final figures come in, we're going to wind up having a lot more job losses than we think we have now.
Now, another concern has been sluggish wage growth. We always see that as something to watch. What do you think are the main reasons behind the hourly wage growth that we saw in September?
Well, it's a little bit surprising. I was just looking through the details in this report today, and there doesn't seem to be any kind of overwhelming pressure on wages. So I think it's wrong to interpret this as a watershed or a period when wages are really escalating. I tend to look at not the headline number, but a different series that takes out supervisory wages. And that one is only up 2.5% year over year instead of 2.9%. And if you're not a supervisory worker and getting incentive pay, then your pay still isn't going up very rapidly.
So then how concerned should we be that wages are still not growing at a pace that reflects the tightness that we're seeing in the labor market?
Well, I mean, the good news is that wages are still rising faster than inflation. So there's an increase in the real wage, and that's why I think things have been better than people think. The wage increases are still slow, but they've been better than inflation. The problem is there are a lot of low-wage jobs being offered, low productivity jobs, and because productivity is low, firms can't pay you a lot of money. And so we're stuck on this treadmill where there isn't any clear way out of it. So I really think we need some investment in order to get workers more productive, and we need to get out of this trap of all the service sector jobs.
So what do you think is going to motivate more investment? As you mentioned, we have this glitchy month with the hurricanes. We're also about to start hiring for the holiday season. When are we going to see some sort of stabilization, do you think, in the employment picture?
Well, actually, and I know Donald Trump is a very popular guy, but I do like some of his policies, and I think that he's been pushing back on trade policy, and any manufacturing jobs we can bring back to the U.S. are good, even if the factories that come back use a lot of robotics, because you will bring factories back, they will pay local taxes, they will hire a higher skill class of worker, and they will contribute to an improved mix of jobs in the United States. So I think that pushing on the trade front for fairness is really the first step in a long road back to American respectability.
And what are some of the other indicators that we should keep an eye on when we're determining the health of the U.S. job market?
Well, when we look at the job market, we look at, there are diffusion indexes that tell you how broadly the job gains are spread, and those shrank quite a lot this month. You want to look at wages. You want to look at hours worked. Hours worked contract this month. In fact, they contracted in 2 of the last 3 months. So some of this weakness in hours worked had nothing to do with hurricanes. You want to look at the kinds of jobs that are being created and the different job classifications, whether they're skilled or unskilled jobs. There are a lot of different things we want to look at in the job market. We want to look and see what's happening with the long-term unemployed. So it's a very complicated market. You want to look at a lot of different things. The Fed spends a lot of time looking at the labor market, but the fact is the Fed has an objective for inflation, and inflation objectives are not being met in the United States, they're not being met in Europe, they're not being met in Japan. And so there's something going on in the economy that's much broader than just the U.S. labor market. The Fed looks at the labor market